Chief Executive of KPMG Australia, Andrew Yates, believes there is a misalignment right now between the political class and big business. We caught up earlier this week following the release of KPMG's annual CEO survey. The survey found that 1 in 2 CEOs are expecting weak growth. Many are investing in generative AI. Most believe office workers will be back full-time within 3 years, and ESG expectations are a major focus.
Well, Ed, you're right. I think it is a challenging economic environment. There's 2 or 3 things that I think are really the focus of CEOs at the moment. Firstly, it's growth. Where is growth going to come from in the current environment? Secondly, really productivity and how are we going to achieve productivity gains? And then I think the onset of technology and how is technology, particularly AI, going to impact productivity in business, but also the future of work. And they're things that really stood out to me in our CEO survey, our 10th annual global CEO survey, which was released today.
Yeah, let's go to the economic environment first. What are some of the big economic pressures that chief executives are feeling at the moment?
I think it really is around where is growth going to come from and how are we going to achieve productivity gains. The survey called out to us, interestingly though, that 86% of Australian CEOs have a high degree of confidence about growth prospects for their company over the next 3 years. So I thought that was pretty interesting. In a pretty low economic sort of environment we're in at the moment, there still is a degree of confidence about the way forward, albeit the growth rates people are thinking about are probably pretty low, around 2.5%. But it really is about how do we try and achieve productivity gains and come out of this low growth environment.
Low growth, high interest rate environment. A lot of people have been hesitant to invest in this environment. So are CEOs thinking about making some big investments to do things like fix productivity over the next 3 to 5 years?
I think that's a real challenge for CEOs. How do you sort of look at the short term and manage the business through the short term, but at the same time invest for the long term? And I think at the moment, a lot of that investment is focused around technology. And back on the survey, 54% of Australian CEOs have AI as their top investment priority. And that's the same in our business. So there's a real desire to think about the long term. The majority of those CEOs do acknowledge that the return on investment will probably come in 3 to 5 years, so a bit of a reasonably long return cycle. But that really is where people are thinking about investing for the long term in the AI and technology part of it.
Yeah, AI technology is becoming a really big thing. Last couple of years it's really exploded. But how do you sort of get your employees to start using it efficiently and train them in learning how to actually use AI to do things like fix productivity?
That's a great question, and I think we're all learning. So at KPMG we've invested in our own AI platforms called KimChat. And we've rolled that out around our firm, and we've had about 10,000 of our people over the last year access and use that. And I think what people have learnt is you sort of start using it like a bit of a search engine, and then as you become more familiar with it, it actually does replace some of the lower value work that our people have been doing and allows efficiency and productivity to come into our everyday processes.
Does it also fit in with the trend that we're seeing a lot of businesses also that are cutting back and slimming down and cutting costs? Does AI come into play there as well?
I think there's a lot of things that come into play there. I think the current economic cycle obviously means people need to be thoughtful about their cost base. At the same time, you do have this technology change coming online. Interestingly, 54% of CEOs do expect headcount to increase in the next 3 years. I thought that was quite interesting. And that's by about 5%. So whilst we're seeing a bit of contraction now, we're seeing the onset of technology, there is an expectation in the majority of CEOs that headcount will increase in the next 3 years.
And that headcount, would it be sort of junior employees they're looking to bring in, or is it sort of highly educated senior staff that they're looking to recruit?
That probably depends on the business. Yeah. But I think certainly continuing to bring younger people into the workforce is absolutely critical. We continue, albeit we've had to think pretty carefully about our overall headcount in the last 18 months. We continue to bring a lot of younger people into our firm to make sure that we're creating opportunities for those people, but also investing in the future of our business.
This week some big companies have talked about bringing everyone back 5 days a week to the office. We've heard from Amazon in Australia. The chief executive of Tabcorp's mentioned it. Yep. Does that come up in the survey as well?
It does, and I was really surprised by the findings there. 82% of Australian CEOs expect that in 5 years' time, white-collar work will be fully back in the office.
Okay.
That surprised me.
Yeah.
I don't think it's the way that our profession and our firm will be, and I think we'll always have a flexible way of working, but certainly I was surprised with a significant majority of CEOs that felt that white-collar work would fully back in the office within that time frame.
Yeah, how does that sort of fit in? Because lots of companies today, they want to be flexible, they want to be a convenient place, an attractive place to work.
Yep.
And then if you have the choice of joining one company which says you have to be there 5 days a week and another which is flexible, you're probably going to choose that one.
These are the challenges of running a modern business, I think.
Yeah.
And it's all about putting trust in your employees, about having a value proposition for employees that's broader than just, you know, where you work and when you work. And that's what we're focused on. But I think it is a real challenge. And I think probably a lot of CEOs feel that some of the productivity losses have been as a result of remote working. But certainly from our perspective, we see it as a really important part of our value proposition for particularly our younger people.
Another challenge chief executives have been dealing with, well, there was a business council dinner this week. We heard from the chairman who said big business has become a convenient scapegoat for a manner of challenging issues. Companies that make a profit are being targeted. Can you understand why he said that?
I can. I mean, I think it's pretty clear at the moment there's some misalignment between the political class and big business, and I don't think that's in the best interest of anyone. You know, I think the intent of everyone involved there is to create a better Australia. I don't think you can criticise anyone's intent, but where that is that misalignment, I think, you know, we need to work together. And I think big business provides incredible value for the country in terms of tax receipts, in terms of job opportunities, in terms of productivity and competitiveness. But big business has made some mistakes in recent years, and so it's fair that we're under a lot of scrutiny. But I think in the interests of the country, we do need to get some alignment between the political class and big business. Yeah,
the interesting thing as well was it's not just coming from one side of politics, it's coming from all sides of politics. So there seems like they're feeling pressure from everywhere.
I think that's fair, and I think that pressure is coming from all sides of politics. I think it's important that companies in Australia do make good profits, they do create opportunities for people, but they do that in a transparent and responsible way. And I think really if we can get those things aligned, then that will create a better future for the country.
And looking ahead, hopefully we'll see the Reserve Bank cutting interest rates next year to ease pressures on households and the economy. But is the government's cost of living relief, energy rebates, tax cuts, is that helping with inflation or causing it to hang around a little bit longer?
Well, it's certainly hung around for probably longer than anyone had hoped and expected. We feel the Reserve Bank is doing a good job of navigating the narrow path, as I think it's called. Our view is that inflation will be back at a level early next year which should allow the Reserve Bank to start looking at reducing interest rates probably around February or March. And that's the sort of time horizon that we're putting on that.
And that CEO survey, I mean, how positive are chief executives thinking about the next 12 months with the way everything is currently going?
As I said before, I was surprised with probably how positive chief executives are thinking about things, particularly over the 3 years. I think perhaps in the next 12 months there still is a feeling that things are going to be a bit flat. We've got to find our way through the macroeconomic challenges. There's a lot of geopolitical challenges happening at the moment, elections all around the world. So there's a lot of uncertainty, I think, that people are feeling for the next 12 months. I think if we can find our way through that, get the macroeconomic settings back where we'd like them to be, that over the 3-year horizon, there's a higher degree of confidence than I'd actually expected before I saw the results of the survey.
I think last time we had you on the show, Ross interviewed you and it was about KPMG and some of the inquiries that have happened in Canberra. Yeah. Just give us an update on how it's all going regulatory-wise.
So, as I'm sure you and the viewers are aware, we've had 2 reports now issued by the New South Wales inquiry and also the federal inquiry, and there is now an ongoing review underway by Treasury. So the first 2 reports were issued. We thought they were sensible reports. We've contributed to the Treasury process, which will conclude at some point next year. So there's a lot of changes already happening in the profession, to be honest, as a result of those inquiries, and we're very supportive of what may come from the others. In terms of KPMG's approach to this, we've tried to be as transparent as we can be, and a few things there around governance are important to us. We have 3 independent directors on our board. You can Google our partnership agreement now, which probably was never going to be the case a few years ago. And we recently released our 3rd publicly available impact plan, where we hold ourselves accountable against a range of criteria, and it's very transparent for people to see. So from our point of view, we're trying to drive transparency and governance and contribute to the inquiry process as it concludes over the next sort of 12 months.
So there's just a little bit of work left?
I think there'll always be work to do. I think, the way I've thought about this is that Our profession has changed incredibly in the last decade, and I think it's fair to say that perhaps regulation, governance and standards haven't kept pace with that. This process has been really good because I think it's going to bring things into alignment. Society's expectations of our profession will be in alignment with the way that we're governed, the way we're regulated, and the way we're transparent about things. So I think there's always work to do, but we're heading in the right direction.
Andrew Yates, Chief Executive, KPMG, thanks for coming on the show.
Thanks, Ed, for having me.